Following today's economic data, Q1 GDP is now forecasted in deep recession territory at negative 1.5%. I will give you all of the details you need to know on our markets and what I think is coming next, because that does not look good at all. So here's the deal. Core PCE month over month came in at 0.3%. It was technically 0.28%, which the estimate was 0.27%. So marginally, just marginally, came in a little bit hotter than expected. But the fact it didn't come in super high was seen as kind of good news. Last month was 0.2%, so this was a slight acceleration, but again, not really the big inflation problem. Here's where things get weird. Personal income month over month came in at 0.9%. The estimate was 0.3%. So personal income exploded higher. One could say that is good news because people are going to have more money to spend. The other argument is this is nowhere close to functional with 2% inflation targets from the Fed. Like, personal income went up almost 1% on a month over month basis. There's no way you get to 2% inflation if that is the trend that we're starting. And last month was positive 0.4%. So like, you were already comparing a high previous month number. So that's like really crazy. Here's where things start to get negative. Personal spending month over month came in at negative 0.2%. You were expecting positive 0.1%. That's not great. Now, last month was revised up from 0.7% to 0.8%, but still, that is a rough number. We've actually not seen personal spending go negative in the entirety of the last year. The closest we got was 0.2%. If you look at the last 3 years, you actually only went negative once, and that was March of 2023. That's why I'm a little nervous for this bounce that it looks like we were starting to see in markets, because this is really bad data. Okay. I mean, even during 2022, when everyone thought we were going into a recession by, September, October, your personal spending numbers were 0.9%, 0.5%, 0.6%. Then they fell to 0%. But I mean, you're negative now. And that really doesn't happen. Why? Because over 70% of GDP is contributed by people spending money. So if people are sharply pulling back spending, that's a big problem. Now, couple this with the goods trade balance that we got today, advanced data for January that came in at negative 153.26 billion versus estimates of 115 billion negative. Not great. Yeah, larger trade balance that's negative. Not great at all. The retail inventories excluding autos skyrocketed from 0.1% as the expectation to positive 0.4%. So inventories are building up. But look at this. Wholesale inventories month over month came in at 0.7% versus an estimate of 0.2%. Okay, why is this so bad? Well, when you mix spending going negative, which it really never does, with inventories that are rapidly building up, and you get an Atlanta Fed GDP Now tracker that is tracking negative 1.5% Q1 GDP. Now, we're very early into Q1. We still have a lot of data to come out, but you went from positive 2.3% yesterday to negative 1.5% today. Like, there is no arguing it. The economy is slowing down. Question is, do we go into a recession or not? And that's why I'm a little nervous, I'm not going to lie, for markets here. Because we wanted to see a bounce. That did not happen. Now, there's other news and other reasons for that we'll get into in just a moment. But I've never seen the Atlanta Fed GDP negative 1.5%. And again, this is going to change. It's going to move back up again. But you're not going to be tracking at 2-3% GDP. That's just not going to happen for Q1. So growth is definitely going to disappoint. And again, you can see here how expectations have changed for GDP. You could see here the latest numbers that we have right here for February 28th. You have GDP negative 1.5%, PCE at 1.3, equipment at 6.3, intellectual property at 5.8. non-residential structures at -2, change in net exports at -248. So the change in net exports what looks like really dragged down the GDP number. But, we're going to have to see. I mean, that's going to make people nervous, though, at -1.5%. Now, the other headlines today that really did not sit right with markets was the Trump-Zelensky-Vance meeting today. This headline here says Trump, Zelensky, and U.S. Vice President Vance argue in the Oval Office. Trump said to Zelensky, "You are gambling with World War III. You have to be thankful. You either make a deal or we are out." VP Vance says it was, quote, disrespectful for Zelensky to come into the Oval Office litigating in front of the American media. Again, you're gambling with World War III. And Vance said to Zelensky, "Have you said thank you once? You went to Pennsylvania to campaign for the opposition." Trump said to Zelensky, "You're running low on soldiers. Then you're telling us you don't want a ceasefire." And then they actually just kicked everyone out of the Oval Office as far as media, and they apparently continued their negotiations. And then it was reported the press conference was canceled, and Zelensky has left the White House early after a contentious meeting with Trump. So it doesn't look like we're going to get a deal there, and that's something that has been a positive for markets recently is the prospect of the Ukraine war coming to an end. And it doesn't look like we're there, or it didn't sound like we're even close to that. The CNN Fear and Greed Index today is coming in at 16. You are in extreme fear territory, almost at midpoint of extreme fear. Yesterday, you were at 18. So this is getting worse from yesterday. The percent of stocks trading above their 50-day moving average today is it was falling. Now it's up 0.64% to about 38%. So stocks are holding up okay right now. But again, that's kind of what makes me nervous as well. If you see a broader market sell-off, then that would obviously be a bigger problem. But still, you're not bullish at all out there. You have almost 64% of stocks trading below their 50-day moving average. So that's a pretty bad number. And here's the main headline on CNBC. It says Trump says Zelensky is not ready for peace after Oval Office fight. You can see today 10-year Treasury yields are down about 5 basis points. Investors are going out and buying the bonds. I think some of this has to do with the Oval Office situation, but the large extent of it has to do with the bad economic data today and that negative 1.5% GDP print. The VIX today is at 21.72. You are up about 3% on the day today as fear continues to escalate. This puts you at, almost a new high, minus the December 18th panic we had after the Fed meeting and the flash crash event August 5th. You're getting up to one of the most fearful levels you have seen in the past year, but I believe this is one of the most fearful levels you've seen since March of 2023. Now, even Elon Musk commented on the collapse of the Q1 estimate for GDP. Elon Musk says a more accurate measure of GDP would exclude government spending. Otherwise, you can scale GDP artificially high by spending money on things that don't make people's lives better. For an example, you could shift everyone who is building cars to working at the DMV. That would result in no cars and a much worse standard of living, but GDP would appear to be the same. What I take away from this is with Doge and reducing government spending, you are likely going to see a continued degradation of GDP. And that's where I have the problem with markets after today's data. It's not that stocks are, too expensive or really nothing like that. I think AI is real. It's going to be around. It's going to make people's lives better over time. The issue I see with markets right now is we're going to be slapped in the face with a larger growth scare. Now, we have already gotten to some degree a growth scare. This sell-off from the all-time highs You could say is a growth scare. You could say it is a tariff scare, a larger trade war scare, among probably other things you could, contribute to this. But I think if the data starts to show some kind of recessionary dynamic, we are still nowhere close to pricing that in. That's where I could see the problem arising over the next couple of months. If reducing this government spending is really going to degrade GDP the way that Elon suggests that it could, and we continue to see weakness in the labor market, that is a problem. Now, the tariffs can also work into that as a problem for companies' investments. I imagine coming next week, there's going to be some kind of extension to the Mexico-Canada tariffs. If there's not, there's a problem. Because what really causes recessions is a slowdown in production, right? It's a slowdown in consumption and a slowdown in production. So if you all of a sudden slap tariffs on and don't give that much of a warning, companies, if you're a aluminum company in Canada and you're going to be hit with this tariff, you don't have time to build a factory in the US, right? And that's why tariffs can be so disruptive to GDP. That company is going to have to take it in the margin or just completely go out of business as is, okay? It doesn't sound like they're going to get exemptions. So, tariffs are not an inflation issue. They are an economic issue. Coming at the same time, it looks like consumers are pulling back. We see this in the personal spending data that I just showed you. Like a negative reading on personal spending does not happen often. Like outside of recessions, it's very rare. And the issue right now for markets would be if the data gets worse from here. If we actually start to come to expect a recession, we're, again, nowhere even close to priced for that. The last time that we were actually, pricing in a recession was back in 2022. And you ultimately fell on the SPY from the peak to trough about 27%. Now, to price in 50% of a recession, given where we are, how far would you need to fall? I mean, probably more than 5%. So I don't think it's the time to sell everything, although I do think it is time that you want to get out of margin. You want to raise as much cash as possible and get ready for lower prices if they do come. Now, with sentiment where it is, it's the 7th most bearish reading for investor sentiment ever. Like, you're probably going to get a bounce, okay? That's probably going to happen. This is probably not the extent of the bounce, although I can say today you would have wanted to see a much larger bounce. The fact that you've sold off 5% from all-time highs and you really didn't bounce much is not exactly a super confident sign. Okay, and I also think it's kind of troubling when you look at the weekly chart here. The 20-day moving average for the SPY, this has kind of been a level where you've really bounced at, okay? Ever since October 2023, you've kind of bounced this level. Even August 5th, I mean, you went below this quite a bit, then you bounced. You bounced at all of these different instances, okay? Even earlier in 2025, in the first, 2 weeks or so, 3 weeks of 2025, you fell below this level. This week, this was the week of January 17th, and you bounced right back up. It looks like we're going to close this week below this 20-day moving average. If we are not able to retake that, that's an issue. And that's sitting at about $600 on the SPY. I don't want to forecast anything necessarily here, but this could be a foreshadowing of what could be to come next for markets. I think it's highly dependent on the data. And if the data continues to get worse, that's going to drive markets. Now, I also see the other issue that markets have had recently is that the Fed is blind, okay? I think the Fed is ignorant and or incompetent to what is going on right now in the economy. With the GDP print that we got today, we will see if the Fed kind of changes their attitude towards cutting rates. But what we've heard even yesterday from Fed officials was that risks are balanced. that the economy's doing okay, the labor market's doing okay. Hello? Like, we could be walking into a literal recession right now. I think a lot of that does have to do with government and Doge and creating uncertainties and a lack of confidence out there. Recessions are also confidence issues. If you don't know if you're going to have a job next week, you don't spend money the same, right? You don't go out and buy that new car the same. You don't buy that new home. So recessions ultimately can be boiled down to a confidence issue. And then from there, the business world, you start to lay people off, and that becomes an even bigger problem. China also made a statement last night. They said that they will take all necessary countermeasures if Trump issues new tariffs on China. But I thought this was interesting, and I want to share it with you guys. I seen this last night and shared it on X. It's from Peter Burson. He runs BCA Research. They are overall a bearish firm, right? They've been bearish for a while. But I think this is interesting. This chart is of the recent deterioration in future headcount plans among American businesses has now occurred across all business sizes. So you're looking at December, okay? December of 2024. All business sizes, besides companies with 250 employees or more, all of them were positive, besides a 3-point reduction in businesses with 250 employees or more. Look at now, February 23rd, 2025. 1 to 4 employees is positive. 10 to 19 employees is positive. 20 to 49 employees is positive. But look at that, 50 to 99 employees, negative 4.1 points. 100 to 249 employees, negative 4.8 points. 250 or more employees, negative 3.3 points. That does not sound good for what the labor market is going to look like. And I just think right now it's an issue because the Fed could be in the process of making a policy error. Okay, if the Fed was bullish right now, if we were expecting a rate cut, at the next Fed meeting, maybe this would not be as bad. But it looks like the Fed is sitting on their hands because of political surveys of inflation expectations and some abnormalities in some of the inflation data recently that have looked like inflation is rising again, although that's not going to be our big problem. So I think Fed policy error, tariffs, less government spending, creating this consumer slowdown could be an issue. Now, I am for not at all calling for a recession. I do think even if we start to look like we're going in a recession more definitively, the Fed will U-turn. But it is the expectation of what's to come, right, that really moves markets. You normally see a majority of the sell-off before a recession is actually declared, right? As you get that first negative GDP print, that's when people start to freak out. Okay, and down 5% from all-time highs with the Fed that is talking very bearishly, and it looks like the administration really doesn't care about the markets this time around, or not nearly as much as they did before. It's a little unnerving. So I do think right now, as far as how to go about markets, you want to raise cash, you want to get out of margin, you want to be able to margin when the larger correction comes. I think we could bounce here, right? You're already down 5%. Fear is at an extreme level. I don't think today's price action in markets looks great, but I do think you could bounce from here, okay? But ultimately, you could fall more. You could fall 12, 15%, 20% if markets start to get convinced of a recession. That's the larger issue I see out there. So yeah, quality stocks, diversified. You can also buy TLT if you're really nervous. That's the bonds, the 20-year treasury. That will go up as markets come down, or as the Fed cuts rates. That will go up. So it's a way to hedge portfolios nonetheless. But I think premiums are a little too expensive for like the SPY or the NASDAQ for options, unless you just want to spend a whole lot of money, which, it's kind of a coin toss. If we bounce from here, your puts are going to get washed. Okay. So worth keeping in mind as well. I just think cash is king right now, and maybe we will see why Warren Buffett has actually been saving so much money right now. He has $335 billion in cash, by far a new all-time high in the latest quarter. We might find out soon why he has been hoarding all of that cash. Hopefully not, but I mean, today's data does not look good. And I think markets honestly should be down a lot more than what they are today based on a negative 1.5% GDP report or at least new estimate from the Atlanta Fed. So let me know what you guys think about this down below in the comment section. Unfortunately, this is one of the most difficult markets I have ever experienced, and I've been in the market since 2016, 2017. It's very hard to figure out what's happening with the consumer, with the economy, you know, with what's Trump's gonna do, the next headline. So I just urge you to have a little bit of caution here and be patient when it comes down to it. If you're long, you'll be fine. If you're short, be a little careful. But I do think over the next couple of months, it could get rockier here. I've actually heard some people say that Trump is setting us up for some kind of slowdown, crash the economy a little bit to get inflation down, to have a big recovery in 2026. And honestly, he doesn't seem to care about the markets all too much these days. So that could possibly be something to consider as well. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.